Are you interested in investing, but it sounds like a foreign language? Don't worry, I got you. Today, we are going all the way back to the basics. Let's talk about stock. When you buy a company stock, you are actually buying ownership in a company, and your goal is for the value of the company and your share of stock to increase over time. So take Apple, for example. If you buy a share of Apple for $300, you hope that the value of the company increases, and eventually you can share that stock for $400, which means you earned $100 on your original investment. Another basic investment is a bond. When you buy a bond, you are actually lending money to the company, and they're going to pay you interest for letting them borrow your money. Eventually, in the future, they promise to pay it back. So you lend a company $1,000, they're going to pay you a 5% interest every year and eventually return your original $1,000. Even though stocks and bonds are the OG investments, most of us today invest in mutual funds. In fact, funds, as opposed to individual stocks and bonds, are most likely the investment options in your retirement plan, like your 401k or your 403b. There are many different types of mutual funds, but it is essentially a collection of hundreds, and in some cases, thousands of different companies. Mutual funds have made it much easier for the new investor to diversify their accounts, especially when just getting started or if you only have a little bit to invest. You may also see something called an exchange-traded fund or a collective investment trust. There are differences between these and your traditional mutual fund, but for all intents and purposes, they're very similar to a mutual fund. The investor is better able to diversify by investing in a fund as opposed to an individual stock or bond. In general, ETFs and CITs run a little more efficiently and charge less fees than your traditional mutual fund, which is why they've exploded in popularity recently. Those are the basic investments you are likely to run into. While this is not always the case, generally, investing in stocks or funds made of stocks is more aggressive than bonds or bond funds. They are likely to be more volatile and change value more frequently than bonds. And this more aggressive type of investment typically translates to greater long-term returns. Bond or bond funds are generally considered more conservative than stocks. And while their value can fluctuate over time, they're typically more stable. It's important to note that there are many different types of stocks and bonds, and each category carries its own level of risk. If this all still sounds like a different language to you, then I recommend you find a certified financial planner. They can explain the different strategies and recommend one that works best for your personal goals. That's it for this week. This is Jeannie, the 401k Lady.